In this video, I'm going to discuss the Chapter 4 Foundation 15 problem. And in particular, this chapter discusses variable costing and contrasts that to absorption costing. To give you a quick reminder, absorption costing is used for financial reporting purposes for GAAP, US GAAP, generally accepted accounting principles. And that's the costing approach that is used by companies to report financial information to investors. Now, absorption costing can create some issues sometimes, and we're going to see that in this particular problem, and hence why companies sometimes for internal purposes use variable costing. So here's the information. The Eggo company manufactures one product that is sold for $80 per unit. So that's the revenue amount per unit. And it's sold in two geographic areas, the East and the West. The following information pertains to the company's first year of operations, in which it produced 40,000 units and sold 35,000 units. So at the core of some of the issues with absorption costing is the idea that if at any point in time you produce more than you sell, like we're seeing right here, here we're producing 40,000 units, but we're only selling 35,000 units. The 5,000 units that remain in inventory, those, and we'll see it firsthand as we do the problem, but I'm just going to give you the big picture here. Those 5,000 units that are not sold, they remain in inventory. And what they end up doing is they end up keeping in inventory part of the manufacturing overhead related to fixed costs. And you'll see how that affects profitability. So every time you build more than you sell, you can, in absorption costing, you can start increasing your profitability little by little by overproducing. Okay? So we'll give you information about the product itself. Direct materials, direct labor, and variable overhead are as follows. And then variable selling and administrative expense as well. And then we have fixed costs. This is fixed manufacturing overhead costs, so this is product related. And then we have fixed S&A expenses. We're told that the company sells 25,000 units in the East and then 10,000 in the West. Okay, so those are the 35,000 units just in two areas. It determined that 250,000 of the fixed selling administrative expenses of this amount, of the 496, 250 is traceable to the West, 150 of the 496 is traceable to the East, and then the remaining 96 to sum up to 496 is not traceable to either one, so it's a common expense. The company will continue to incur the total amount of its fixed manufacturing overhead costs as long as it continues to produce any amount of its only product. So in other words, even if we get rid of a line, either West or East or whatever the case may be, we still are going to incur 496 of fixed cost. That's what they're saying. And in reality, that's usually the case, because getting rid of your fixed cost in the short run is very hard. This relates to depreciation of buildings. This relates to depreciation of machinery, etc. Those are big ticket items. And in the short term, you can't get rid of those things. So even if you change things up, many times the fixed cost, okay, whether it's manufacturing or selling and administrative expenses, those are sticky. They stay. In the long run, you can start doing things to improve the cost structure, but in the short term, it's hard. So when we look at this, it says answer each question independently. Okay, so we're not going to rely on one question to answer the other based on the original data unless instructed otherwise. You do not need to prepare a segmented income statement until question 13. Okay, so let's start with 1. Under 1, what is the unit product cost under variable costing? Okay, so we're going to go in here and we're going to do variable costing, and we have direct materials, direct labor, variable overhead as well. So we'll put that over here. And just to be more specific, this is variable manufacturing overhead. Okay, and we also have, well, under variable costing, that's all we're going to have. So our unit cost under variable costing is going to be 24 as given, direct labor is going to be 14, and then our variable overhead, which is given as well, $2. So when we do this, we have a variable cost per unit of $40. So if we were using a variable costing approach for the product costs, then we would say that the cost per unit, and that includes only variable components, variable manufacturing components, is $40 per unit. Okay? And then question number 2, I believe asked for absorption costing. Yes. So what is the unit product cost under absorption costing? So let's go ahead and do that. Under absorption costing, let me center all this stuff right here. We will still have the 24, that's still there, the 14 and the 2. But now we include fixed manufacturing overhead, okay? And we don't have any information as to how they're applying overhead, but we do know that the total manufacturing overhead was $800,000. So if the total fixed manufacturing overhead was $800,000, then on a per unit basis, okay, so fixed manufacturing overhead per unit would be 800,000 divided by the number of units produced. Okay, be very careful, units produced. So you spread these costs over the number of units produced, not sold. When we do the income statement, that's when we use the number of units sold. But for costing purposes, for estimating the cost, this is 40,000 units. As you recall, this is what we produced, 40,000 units. So that gives us $20. So what does that mean? That under absorption costing, the product cost is going to be $60. Okay, so we've answered 1 and 2 there. So let me go ahead and just do this here. This is answers for 1 and 2. And then let's go ahead and see what we're being asked for next. So for question 3, we're asked, what is the company's total contribution margin under variable costing? Question 4, what's the company's net operating income under variable costing? So for 3 and 4, basically we're doing an income statement under variable costing. And then for numbers 5, what is the company's total gross margin under absorption costing? And the net operating income under absorption costing. For 5 and 6, we're doing an income statement under absorption costing. So it might be nice to just kind of have these side by side so we can see. So I'm going to do 3 and 4 here, and then maybe 4 and 5 if I can fit them on this side. Okay, so I'm going to go in here and say income statement basically under VC, and then for this we'll have income statement under absorption costing. Okay, so let's start off with sales here. We're told that we sell 35,000 units. So notice how now I'm going to use the 35,000 units for computing sales. And we sell each item for, let's see, where was that amount? Oh, here it is. So we sell each item for $80. So this is going to be, under absorption costing, it's going to be 35,000 units times 80 per unit. Okay, and that ends up being, let me just do the computation here, $2,800,000 is what that is. Get rid of some space here. Okay, good. So the next thing that we're going to subtract is our variable product cost. And you could call it several things. You could call it variable cost of goods sold. You could call it a variable product cost, however you want to call it. It's still the items related to production, okay? So we said that we're selling 35,000 units, and we said that each one of those has a variable cost of $40. So we'll go ahead and do that. And This ends up being $1,400,000. All right, the next item is the variable non-product cost. Okay, so this is the variable S&A stuff, selling and administrative expenses. So since we're doing the variable costing, we're going to first subtract all the variable costs to get to contribution margin as follows. And then we subtract fixed costs, okay? So the variable selling and administrative expenses, they tell us it's $4 per unit. So I'm gonna go in here and 35K times $4. And that ends up being $140,000. And then we can compute our contribution margin, which is sales minus variable product cost minus variable S&A. So our contribution margin is $1,260,000, and this, the way we think about it is, I have $1,260,000 towards to cover my fixed costs. So let's go ahead and do fixed product related, and then fixed selling and administrative expenses related or non-product related. So the way I think about these sometimes is this is product, this is non-product related. Product related, non-product related. All right, so fixed was product related is $800,000. That's given. And then fixed S&A is $496,000, which is also given. Since we're doing a combined income statement, we don't have to do these breakdowns of 250, which corresponds to the west, 150, which corresponds to the east, and 96, which is common for everybody. So this is just an overall income statement under a variable costing. And what this gives us is our net operating income or net operating loss if it's negative. So let's go ahead and figure out what that is. This minus that and minus this. And we get a net operating loss of $36,000 for a sales level of 35,000 units. Okay, so that takes care of questions 3 and 4, where they ask us for the contribution margin. That's 3 right here. And then the 4, net operating income, which is technically a loss at this point for variable costing. Okay, so if we do the income statement under absorption costing, then we start off with sales as well, same thing, and it's going to be the same sales amount of $2,800,000. So let's see what that looks like. So we have $2,800,000 here, and then the next item we subtract is cost of goods sold, and our cost of goods sold here, just to be clear, is going to be made up of the variable product cost plus fixed product cost. So when we do the income statement under absorption costing, we're including only production costs here in the cost of goods sold. So if you recall, that amount was $60 per unit. So this is going to be 35,000 units sold times 60. And let's do the math real quick here. And that gives us 2,100,000. Okay, so this gives us gross profit. So it's a different way of looking at the profitability, whereas here we're looking at it from the perspective of I have 1,260,000 towards fixed cost. In this case, we didn't have enough. Under the absorption cost, and what we're saying is this difference of $700,000 is something's not right there. Let me just type it in. This difference of $700,000 is the markup on my products. So if my costs are 2.1 million and I'm selling them for 2.8 million, it's like saying I'm marking up the cost $700,000. Just another way of looking at it. And then minus S&A, selling and administrative expenses, which we were told are $4 per unit plus 496,000. So this is going to be 35,000 times 4. That's the variable component. Let me put some brackets here. Plus the fixed component. So we got to include that fixed component of 496. That's the selling and administrative expenses. So when we sum that up, that gives us $636,000. And that means our net operating income here is positive. So that's going to be 700 minus 636. Okay, so what we see here is a difference between the two approaches in terms of profitability that should make you think. If we use variable costing, we have a loss based on the sales level of 35,000 units. But if we use absorption costing, we have a profit of $64,000. And you know, the question is, where is that coming from? So let me put a little bracket here if I can find one. I thought I had one. Here we go. Okay, so let me put a little bracket because we need to explain this difference. And that's key. Okay, so here's the difference between these two approaches is $100,000. And we need to think about why that's the case, this difference of $100,000. And that's what we're going to explain in the next few questions. And what we'll find out is that this difference of $100,000 going from negative 36 to positive 64 relates to the fixed manufacturing overhead. Okay, so I'm going to give you the punchline right now and we'll just highlight it. But the idea is this: under variable costing, we're always going to expense the whole fixed product cost. And under absorption costing, we're always expensing all the product costs, but do keep in mind that since we made more than we sold, more specifically, we made 40,000 units and we sold 35,000 units, there's 5,000 units right here. The difference between these two, there's 5,000 units in inventory, which are keeping in inventory part of this $800,000. And the question is, how much of it? They're keeping $100,000 in inventory as opposed to expensing. Okay, so let me repeat that again. The 5,000 extra units that I made that are currently in inventory, they're not in cost of goods sold, those are keeping part of this. See, each unit we make, we assigned $20 of fixed manufacturing overhead to each one of those units based on the 800,000. Well, if you do variable costing, you expense it all. But if you do absorption costing, not all of the $800,000 is in here. Part of it, 100,000, is in inventory, because if each one of those items gets $20 per unit of fixed manufacturing overhead, and we have 5,000 of them in inventory, then 5,000 times 20 is your $100,000. And we'll do the math in a little bit more detail so you can see. And you know, some people would argue, why then do we use absorption costing? And there's an argument, a positive and negative for everything. Under variable costing, the positive is that we don't have those distortions. No matter how many units I produce and sell, and no matter what the difference is between the production and sell amount, this is how it's always going to be. I'm going to always remove that $800,000. Whereas under absorption costing, so that's a positive for variable costing. Whereas for absorption costing, we just saw how that's not the case. We're not going to remove the whole 800 unless we produce and sell the same amount. So why absorption costing? Well, the argument is that under absorption costing, we include all costs related to production as part of the product cost, as part of the item that we're making. Whereas for variable costing, we're only including the variable components. So look right here. When we did this calculation, For variable costing, the unit cost is 40, whereas absorption costing is 60. And the argument is product cost should include everything. Every part that I incur should be included in there. That's the idea behind absorption costing. Okay, so that's 3 and 4, and then 4 and 5. Let's look at number 6. What they're asking for in number 6. Okay, so what is the company's net operating income? Oh, I think we did. Wait, let me see. Bear with me here. I see the mistake I made. This is both 5 and 6. Sorry about that. So that now we are on number 7. Okay. So under number 7, let's say what is the amount of the difference between variable costing and absorption costing net operating incomes? And we just addressed that actually. So that's the $100,000 that we mentioned here. So maybe I should just move this to the side here, and then that way we answer the question. We also talked about the nature of that difference, right? So it's coming from the fact that I made, just to be more clear, I made 40,000 units, 40K units, and I sold 35K units. So the difference of 5,000 units or maybe I should say in inventory, what remains in inventory is 5,000 units, and at the fixed manufacturing overhead cost per unit of $20, that's where the 100,000 comes from. Okay, so fixed manufacturing overhead per unit, we said it was 20. When you do that math there, that's the difference explained. The multiplication of those 5,000 units times 20 per unit, which is 100,000. Okay, that's where it's coming from. All right. So now we move on to number 8. The question on number 8 is, what is the break-even point in unit sales? Is it above or below the actual unit sales? Compare the break-even point in unit sales to your answer for question 6. Okay, so this is a good one, because what we learned in the previous chapter on cost, volume, profit analysis is about the break-even point, but more specifically, what we want to make sure we understand is that when we talk about those break-even points, it applies when we manufacture and we sell the same amount. And so, in a sense, the break-even point is descriptive of variable costing income statement. It will, the break-even point will always explain to you how many units you need to sell under variable costing. And maybe I shouldn't say it that way. Let me restate that. The break-even point is going to tell you how many units you need to produce and sell during that period in order to generate zero profitability, right? It'll work under both variable costing and it'll work also under absorption costing, assuming that for absorption costing you produce and you sell the same things. Here in our scenario, we produced 40,000 units and we sold 35,000. So the break-even point, you'll see in a minute, does not jive with this. Whereas that issue never arises with variable costing. If you do a variable costing income statement at the break-even point, you will get the zero here every time, the net operating income of 0. So let me explain what I mean there. Okay, so let me go to 8. And under 8, the break-even point, if you remember, there's different ways of doing it, but a real easy way is just to say, get my total fixed cost and divide it by the contribution margin per unit. Okay? So here, our total fixed costs were a combination of two things. The 800,000 and the 496. Okay, so that's on the numerator. 800,000 plus 496,000. And that'll be divided by the contribution margin per unit. And I'm just going to do the computation directly in here, but it's basically the sales price minus all variable cost. Okay, so that'll be direct materials, direct labor, the variable manufacturing overhead minus the variable selling and administrative. So when you sum those up, that's 24, 14, that's 38. 38 plus 2 is 40, and then 40 plus 4 is 44. So when we do that, we get a contribution margin of 36. And the break-even point ends up being 36,000 units to break even. So this is why it's quirky. Look, we sold 35,000 units, which is below the break-even point. And yet, under absorption costing, we're showing that we have profit. And that's because under absorption costing, if you produce more than you sell, you're going to have a distortion. Okay, so the break-even point really applies to doing your income statement as under a variable costing approach. Look how here we get a loss of 36,000 because of the fact that we only sold 35,000. By the way, it just happens to be that this is 36,000 and this is 36,000. Please don't mix them up, okay? This is a loss of 36,000 when we sell 35,000 units. But if we were to sell 36,000 units under variable costing, this would be zero. Net operating income would be zero. That would be the break-even point. All right? So that's why we get this little distortion here. Anytime you produce more than you sell, then you have to be careful in terms of the type of analyses that you do under absorption costing. And break-even point is one of those types of analyses. So if you're in a period where you produce X amount and you sell X amount, the same amount, then absorption costing will work perfectly in terms of the break-even analysis. But most of the times companies are producing some amount different than X and selling X. So that's where we need to, as managers, understand the pros and cons of absorption costing. And clearly this is one of those bad things, not bad things, but just the things that as managers we need to be aware of, okay? All right, so now let's go to question number 9. Let's see what question number 9 says. Question number 9. If the sales volume in the East and the West regions had been reversed, what would be the company's overall break-even point in unit sales? Well, it really doesn't matter. And the reason it doesn't matter is because the contribution margin is the same. So actually, let me, since the contribution margin is the same for East and West, break-even point is not changed. In other words, you still need to sell 36,000 units to break even because of the fact that we sell this item for $80 in the East and we sell it for $80 in the West. If for some reason you had different sales prices in different regions, then at that point you would have to redo the math and see how that would affect your break-even point. But here it's the same because the contribution margin per unit is the same whether you're in the East or in the West. So you still need 36,000 units sold to break even. All right, number 10. What would have been the company's variable costing net operating income if it had produced and sold 35,000 units? You do not need to perform any calculations to answer this question. Okay, yes. So I'm gonna, you know what, they don't want us to do the computations, but I will. So I'm gonna copy this one. And here's what I'm gonna say. So this is number 10. Let me erase this. So this is the income statement under variable costing in the scenario where I produce 35K and I sell 35K. So what you find is that this doesn't change. Okay, this is the same under variable costing. And you know what? Let me go up here and add that on here. So for 3 and 4, I should have added produced 40K and sold 35K. Because I'm trying to drive the point that under variable costing, it doesn't matter what this difference is. You're still going to get a negative 36,000 net operating income. Same thing here. Net operating income is going to be 36,000 even if you produce the same. Now, what changes now is this one here. And I hope some of you are kind of thinking ahead and thinking of what that amount will be. So let me put this here. I'm going to change some things around, so don't think that that's the answer. 1 second here. Let me erase this. I'm going to add over here. I'm going to add that we produce and sell 35K. Let me erase all this stuff here so we can just do it from scratch. Okay, so sales amount will be the same. That doesn't change at all. And then what does change, we need to go and see what the cost per unit is. So that right here is $40 for the variable components. So we can do that if you like. Let me go down here. And what will change here is that now our cost of goods sold will still be 35,000 units times the cost per unit, right? The absorption cost per unit. But here's where things change. When we first came up with this cost structure here of $60, this was based on the idea that we manufactured 40,000, but now we're changing the whole scenario. So let me take this down over there so that you can see what I mean by that. So now our cost is not, our fixed manufacturing overhead cost per unit is not $20, okay? Because we're gonna be dividing this by 35,000 units made, which means, let me do the math real quick. That's 800,000 divided by 35,000. And that's $22, roughly $22.86 per unit. Let me bring this back so we can see it. 22.86. So 22.86 is that. So notice that when I produce 35,000 and I sell 35,000, then the cost structure changes, because at this point I'm going to divide the 800,000 by 35,000 units, and what we get is that we need to cost 35,000 times 62.86. Okay, so I'm going to go in here and say 30. Let me do the formula: 35,000, 1, 2, 3 times I'm going to just round 62.86. Okay, so that's 2,200,100. And if you have been understanding more or less what's going on, you'll know that the number we're going to get right here is a negative $36,000, right? Because of the fact that if I produce 35,000 and I sell 35,000, the whole $800,000 of fixed production cost will be expensed right here. So let's verify that. Of course, that's not going to work. Equals, there's probably a format issue somewhere. Oh, I see what's going on. There should be another 0 here. No, that doesn't look right. Okay. So we're going to do 2,800,000 minus 2,200,100. So that's our gross profit. And when we subtract out selling and administrative expenses, which is the same from before, $636,000. Okay, $636,000. We get a loss of $36,100, which because of rounding error, we have this $100 difference, okay? But technically, it's the same as this 36,000. And the rounding error deals with the fact that this doesn't come out to 2286. It's a longer decimal placement, but I just rounded it to 6286. But technically, if you did not round, this would have came up to be negative 36,000, just like under variable costing. Okay, so what can we conclude at this point? If at any point in time you have a production level that is the same as the sales level, your incomes under variable costing and absorption costing will be the same. Furthermore, under absorption costing, you're not going to get that distortion that we originally saw up here when we overproduce. And the distortion I'm talking about is that under absorption costing, if you overproduce, you're going to push up profitability because some of the 800,000 or the fixed manufacturing overhead costs are going to be kept in inventory. But if you produce and sell the same thing, none of that 800,000 is kept in inventory. All of it will go out to cost of goods sold. Okay, so that was question number 10. Let's go ahead and look at, oh, you know what? We did questions 10 and 11 right there. This would have been 11 because they're asking what would have been the company's absorption costing income statement and if it had produced and sold 35,000 units. And the reason they say here you do not need to perform any computations is because after you understand this, you realize that, hey, whatever income it was under variable costing, if I'm producing and selling the same stuff, that income will still be the same for absorption costing. All right, so let's move on to number 12 here. And number 12 says, if the company produces 5,000 fewer units than it sells in its second year of operations. If it produces 5,000 fewer units than it sells in the second year of operations. In other words, since we built up inventories in the first, recall that each question is independent of the others, okay? So this refers back to the fact that we made 40,000 units and we sold 35,000. If that's the case, we have 5,000 units in inventory for next period. So that's what they're saying here. They're saying under 12, if the company produces 5,000 units fewer this period, or I'm sorry, the second period, than it sells, will absorption costing net operating income be higher or lower than variable costing net operating income? And no calculations are required. Okay. So let's assume that this is period X1. Everything we've been talking about is period X1. So in period X1, whatever that period may be, we had 5K units left over in inventory. Then now in this question, we're talking about period X2. So in period X2, we will liquidate these units from X1. Okay, so that we understand clearly what's going on right here. And that's what they mean by if the company produces 5,000 units fewer than it's sold because of the fact that we had inventory. Okay, so how would the net operating income compare with absorption variable costing NOI versus absorption costing NOI? And let's think about that. Whatever and they told us not to do the calculations, but whatever the amount will be, it'll be the reversal now, because if you're bringing back some of these 5,000 units from the previous period, they come with fixed overhead costs from the previous periods, which means that there will be more expense under absorption costing. So what we'll have is the income will be higher for variable costing than for absorption costing. And if you want to think about it a different way, recall that under this scenario, where we produce 40,000 and we sell 35,000, under variable costing, I expense the whole 800,000. Under absorption costing, I did not expense the whole 800,000 because some of it is kept in inventory. Well, it's that amount that is kept in inventory that now is going to come back in period X2 and give you more expense, meaning less income. And that's why this works this way. It's just, you know, it reverses out in the following period if this is the case. Whereas under variable costing, we don't see those distortions. It'll be the same. We will expense the fixed manufacturing overhead that relates to that period alone. Here, we're going to expense the fixed manufacturing overhead that relates to that period, plus a little bit of fixed manufacturing overhead from the previous period for the units we overproduced last period. All right, let's look at number 13 here, question 13. Prepare a contribution margin or a contribution format segmented income statement that includes a total column and columns for the east and the west. Okay, so this is a segmented income statement, so let's go ahead and do that. Segment variable costing income statement. So we're going to have the east, the west, and then total for the company. So for the east, we have sales, we have variable, all variable costs. Variable costs, we're just going to throw them all into one, and then that gives us contribution margin. And again, this variable cost right here is going to be related to both product and non-product related stuff. We know the total here is 800,000 from before. So now we're just saying what corresponds to each area. And I believe for the east, we sold 25,000 units, and then for the west it was 10,000 units. Okay, so let's go ahead and work with that. Okay, I think we're on 12 here, sorry. Oh no, my bad, this is 13. Yeah, 13. I'm losing track here of where I'm supposed to be at. Okay, there's 13. All right, so this would be, we said 25,000 units times 80. That's the sales price. And then this is 10,000 units times 80. Okay, so when we add these two, the total, I don't know where I put 800,000 here. This was 2,800,000. Sorry. I hope somebody caught that as I was writing it. In other words, that's just our total here. That's all. Okay, I only put the 800,000. But if we have 2 million from the east and 800,000 from the west, the total is 2,800,000. Okay, good. And then for variable cost, that's going to be all variable costs. So let me just bulk it up as one. We had 24 plus 14 plus 2, which we said was 40. And then variable selling and administrative expenses, that's 44. Okay, so the total variable cost, both production and non-production, is $44. So when I come over here, I'm going to do the same 25,000 units times 44, which is 1,100,000, and then this is going to be 10,000 units times 44. And maybe I should put some commas here just so it's easier to follow. All right, so the summation of these two is 1,540,000 on a total basis. This gives us contribution margin. So let's just running through these formulas here real quick. And we get a contribution margin in the east of 900,000 and in the west of 360,000. Okay, so this is now where we have to be careful. The traceable fixed costs for the east, they told us that of the 496, of this whole 496 amount, they told us that 150 was traceable to the east and 250 to the west. So I'm going to put in here 150. And then this one is supposed to be 250. Now, be careful. We still have 96,000 to account for, but we'll do that for the total bit column in a minute, okay? So I'm going to go in here and sum this up and say, okay, so far I've accounted for 400,000 of the fixed cost, but I still have 96 to account for. But what it does allow us to do is to get a, let me get a line here, get us a segment margin. So the margin for each segment. Oops, there's no G there, sorry. Let me make this a little bigger. So for the east, that's a profit margin of 750,000, and then for the west, that's a profit margin of 110,000. Overall, what that is the summation of these two. Let's see if that works. 860,000. But we're not done, because then now I have to subtract. I'm going to call them non-traceable, or you can call them common fixed cost. It's another way of doing it. But these are the ones I wasn't able to assign here, and that's the $96,000 that remains, right? So we have the 96,000 that remains of fixed cost right there, plus, don't forget the 800,000 of fixed manufacturing overhead. So we got to do all of the fixed costs. Okay, we were able to assign 400 of the total of this to east and west, but then the remaining amounts we weren't able to assign them specifically. So that's where now we are bulking it up as one. So when I get this amount right here, let's see if it works. Nope. There we go. It's 896,000. And I'm going to subtract this, and this gives us our net operating income or net operating loss. And it should be a loss of 36,000. Okay? All we did was present things in a different way so that we can provide segment information here. That's all. This is what this gives us, where we get the margin that's based on traceable fixed costs for each segment, and then whatever we can't trace, then we just bulk it up at the end as an overall number, like we did right here. Okay, so now let's look at number 14. And under 14 it says Diego is considering eliminating the West region this year. Considering eliminating the West region. Because an internally generated report suggests that the region's total gross margin in the first year of operations was $50,000 less than its traceable fixed selling and administrative expenses. Diego believes that if it drops the West region, the East region's sales will grow by 5% in year 2. That's the East, so the East would grow. Using the contribution approach for analyzing segment profitability and assuming all else remains constant in year 2, what would be the profit impact of dropping the West region in year 2? Okay. Well, first, let's talk about this $50,000 less that the manager is thinking about. So let me do that. 14. Should we drop the West? Because 50K unprofitable. Let me show you what that means, what that's about. So if we do an absorption costing income statement for just the West, we have sales, and their sales are $80 times 800,000. I mean, yeah, $80 times 10,000 units, so that's $800,000. And then if we get the cost of goods sold, okay, based on the original data here, meaning absorption costing, let me put a line here. Absorption costing cost per unit is 60. So if we do the income statement under absorption costing, cost of goods sold is 60. So we'll go over here and we'll say, okay, that's based on 10,000 units times 60. So that's 600,000, meaning my gross profit is the difference of 200,000. And then I bring in the traceable fixed cost of 250,000. Let me see if I can include a little arrow here. So in other words, the manager is thinking, you know what? These are the fixed costs related to the company. So this is fixed cost of 250,000. And that gives us that loss that the manager is talking about of $50,000. So I'm just trying to get you to see where that loss that the manager is seeing is coming from. Okay, they're going in there and say, okay, this is my cost, these are my product costs, and these are my non-product costs for fixed items, and this is where I'm getting this $50,000. So the thinking behind the manager is, if I get rid of the West, okay, under absorption costing, I would get rid of this $50,000 loss. And that's not accurate, okay? That's not accurate because currently the West is actually helping 110,000 to cover the additional fixed costs that we have in this company. So let's do the analysis here. If I get rid, okay, so if we eliminate the West, we lose the segment margin that we lose is 110,000. So I'm going to represent that as a negative here. There's different ways to illustrate this, but this is one way. So if I eliminate the West, my segment margin will go down by $110,000. They did say that if we eliminate the West, the East increase in sales in East will be 5%, I believe. Yes. So if sales, or if the contribution margin right now in the East is 900,000, if we get rid of the West, we're going to have 900,000 plus 5% of that. So we would have the increase. So we're looking at the differences now. The increase here would be 900,000 times 5%. In other words, if we get rid of this, we lose out on 110,000, but we gain 45,000. So what does that mean? It means that getting rid of the West is a bad idea because this will create a decrease in profits for the whole company. Of that difference. So this, sorry, hold on. So we're going to do this plus this. If we get rid of the West, we are not going to increase profits by 50,000 as the manager naively thinks, okay? For this purpose, for analyzing whether you want to get rid of a line or not, you do not go to the absorption cost and income statement. You look at your variable cost and income statement and ask yourself, is this segment at least contributing to cover other costs? In this case, it is. So by getting rid of the West, we're eliminating this $110,000 that we're currently getting from the West. Even though we're not profitable overall as a company, getting rid of this will just make things worse. It'll make it where now the overall company is going to have a bigger loss, a $65,000 loss, in addition to this $36,000 loss. And then finally, 15 here. It says, assume that the West region invests $30,000 in a new advertising campaign that will increase unit sales by 20%. If all else remains constant, what will be the profit impact? Okay, so let's go ahead and analyze that. If we do additional advertisement, that's minus $30,000. In other words, we got to put in that money. We got to invest it. And what's the return that we get? Okay, so increase in sales will be equal to the margin of the contribution margin of the West times 20%. So that'll be equal to 360,000 times 20%, which is 72,000. So the increase in profit for the whole company is, let's do the math right here, and that's $42,000. So that's a better alternative. Instead of going the approach of eliminating the West and losing out on additional profitability for the whole company, maybe this additional advertisement campaign that's going to cost us $30,000 is a good bang for the buck, because it's going to end up increasing profitability for the overall company by $42,000. In other words, if we're currently at a negative 36, the overall profitability for the company will be $6,000, the difference. This is going to contribute to it. And I don't know if you noticed how I was using the contribution margin every time I did these computations here. If you wanted to, you could go and compute the whole sales amount by the change in percentage. So if this went up 5%, go ahead and change it, and then this goes up 5%. And what you'll notice is that we could just use the contribution margin at 5%, and in this case at 20%. But technically, you could go in there and add 20% to this, figure out what that is, add 20% to this, figure out what that is, and then get your difference, and that difference is 72,000. So a quicker way is just to apply the, let me see where I did that, the contribution margin times 20%. And and that's why we do these things. That's why we learn about these things, so that we can quickly understand how to analyze changes without having to recreate things. Okay, this concludes the video on chapter 4, I believe. Yes. Oh no, chapter 4. Yes, on variable costing and segment reporting.